Hey everyone, and welcome back to another edition of our Best of Top Traders series. This week I went back to a conversation where Catherine Kaminsky and I sat down with Nigol Koulajian, the founder of Quest Partners, in which he shared a lot of his personal experience, including a few life lessons and his take on many key areas in trading. There were a few short segments that I thought you might really like, one of which was Nigol's take on the problem with smart beta. The other, his explanation of his statement of filtering. Is that the holy grail? So without further ado, let's jump right into today's topic. And if you want to listen to the full episode, just go to toptradersunplugged.com/101 and also toptradersunplugged.com/102. Just curious, maybe on a slightly different tact, you say, you bring up the word smart beta.
Yeah.
And of course, in our industry, and in particular in the trend following space, it's been over the years, it's been, certain firms promotes trend following as being a very easy risk premium to replicate. And so they sell their products very cheaply.
Sure.
Yet I have not really seen that these products have outperformed the true, veterans in that particular strategy.
Sure.
So I'm just curious here. So when you say, but the smart beta products, some of them have raised billions of dollars, interesting, because people look at the fees and say, oh yeah, it's easy, so we shouldn't pay so much for it. Yeah. But so when you say you should short smart beta and do everything around it, I mean, what should you then do because I'm curious whether in fact that smart beta, and I'm referring it to trend following because it's easy for me to understand, right? I mean, is smart beta overrated in some ways, that it's maybe not as effective to capture that risk premiums in some ways?
It's very effective when nobody has money in it.
Right. Okay.
So
okay.
So the issue with smart beta is that with transparency comes a certain amount of decay. Okay. So although you have multiple firms, each firm is managing 3, 4, 5 billion in smart beta type of products, or AQR is managing, 15, 20 billion. Yeah. The returns were great just prior to them raising the money. And typically, so take an AQR replicator. Let's say you use 12 months momentum, 6 months momentum, 3 months momentum. In combination, you end up with like 80-85% correlation. But then you see that relative to that basic replicator, once they actually raised the assets, then they had substantial decay in performance relative to their own replicator. Right. So there's what I'm trying to say is that there's although it seems that individual CTAs are trading 1, 2, 3, 4, 5% of volume or 10% of volume VWAP and very gentle and making markets, still markets are heavily influenced by CTA trading. And at the points where liquidity is required, there's not that much liquidity. I mean, CTAs are a very big percentage of volume in the market. It's easier to see that trading short term. You say, like, how are my assets influencing my slippage or that type of thing, and seeing what type of influence you have. We're trading 1 or 2% of volume, 3% of volume, but I think we still have impact. And analyzing the impact on short term, then going and applying the same techniques of analysis to longer term, you say the same exact thing is happening to long-term trading, where you're running, hundreds of billions. Yeah. So going back to smart beta is great when nobody has money in it. The more assets come in, the more those specific entry points are going to be effectively, those entry points or those techniques are going to become counterproductive. Yeah. So trend following works. I can give you that as a general statement, as a technique, because it captures something that individuals or investors don't want to do, which is trade,
buy the high and sell the low, which is intuitively feels weird.
Correct. Yeah. So the natural thing, human beings, whether you're in kindergarten, whether you're in high school, whether you go to business school, everybody teaches you buy low, sell high. Nobody wants to do the opposite. So that those psychological biases are why trend following, which is a technique which is, I would say, cyclical in return, it's definitely not a straight line, sometimes works and sometimes doesn't. But when people believe in it, it stops working because the assets influence it. And I'm going to say this is a very, very big factor that you cannot look at smart beta outside of this factor. And it's not that investors are coming in because there was a run in return. I don't believe it's purely a timing issue, like coming in 2009. I believe that the assets coming into a strategy are actually having a major impact. That's my opinion based on what we see in the short-term space. And again, applying the same things to long-term.
And just staying with that a little bit, because now you're sort of talking a little bit about industry capacity and so on and so forth. But what about the short-term space in itself? I mean, where do you think that some of the techniques that you use, you say 1 or 2% of volume, but even that you can see the footprint. I mean, where is enough in your space, so to speak, not to end up in the same place as all the ones who've sold smart beta but are not delivering for their clients?
So the death of channel breakout is, buy, let's say the turtle system, buy a 50-day high, sell a 50-day low type of thing with a shorter term stop loss, came when the model went public, late 90s, early 2000. Those models had straight line equity curves and flatlined in the 2000s. Then longer term techniques such as, typically used with moving averages, exponential moving averages, flatlined later in 2009, right? So in the short term space, let's say things more similar to vol breakout, flatlined definitely since 2009 when the vol has been low, but they were with filtering. So let's say the smart beta in short term was that long time ago. Right. But using certain types of filtering, you could still survive and make alpha. Then it became the more the vol compressed, the more difficult it became. Yeah. So I would say short term, smart beta is dead, long dead. And as a matter of fact, you can trade against it, which is what all those mean reversion models that you see today are. Right?
Well, you talked a little bit about filtering. Could you maybe clarify a little bit more how you think about that and what you mean by filtering?
Filtering is like the holy grail, if you want. I mean, basically, the alpha comes from filtering. So filtering 15 years ago, trade momentum or trend following only when the vol is compressed. That's one way. That's the way it was. Then maybe 5-10 years ago, it was trade momentum in the direction of the negative skew. And then the skew in option pricing tells you that effectively, if a market starts to go down, there's going to be a trend. There's going to be a very strong drift. If the S&P starts to go down today, the market is expecting that it's going to lose 20% a year. That type of thing. So that's another way of filtering. So the market is telling you that if we go down, we're going to go down a lot. So, okay, we'll go along with you. No questions.
So do you think that you need to spend more time really thinking about that in today's markets as opposed to a few years ago? Is that sort of the secret sauce, I guess one might say?
There's more clarity gained around not the way the markets are, but the way people trade. I don't believe that the markets are a certain way that if you're long the S&P, you make 7% a year, and if you're long term, CTAs, you make 10% a year. It depends what people are thinking and the way people are trading, and the way to on the run evaluate the level of conviction and risk people are taking. Where is the surprise potential? So vol compression was 15-20 years ago. Convexity was 5-10 years ago. Today, a lot of what we do is around crowding. Effectively, trade against whatever feels good, do the opposite. And you can do this looking at the relationship between the returns of different sectors within momentum. You can look at certain markets within a sector and assume that things are going to mean revert.
So if it's uncomfortable, that's a good thing.
Correct.
I guess.
If it's uncomfortable, or the way we're programmed to think, how does the way we are comfortable thinking lose money? That's why we bet on that. So today you can hire people out of undergrad who can run optimizations that quadruple PhDs couldn't do 20 years ago. But the techniques available for optimization are pretty much free. As a result, the way people are chasing returns and therefore reinforcing short-term bubbles and then breaking them down, how do the markets depattern themselves, is really critical. It's changed. And our job is to basically find ways to provide this convexity with positive alpha at the same time by relying on what people are comfortable doing and trading against it in all time frames. It's available. You can hire 10 quants and they all tell you the same thing, and you do exactly the opposite.
And there you have it. If you enjoyed this short, insightful clip from a past episode of the show, then you will love the new free book that I'm giving away right now. It's called The Many Flavors of Trend Following and includes some of my best insights on this perhaps the most dependable and consistent yet often overlooked investment strategy. You can get a free copy at toptradersunplugged.com/book right now to start your own investment journey today. Just go to toptradersunplugged.com/book. And make sure to come back to the podcast or my YouTube channel next week for more exciting and engaging conversations.